uncomfortable procedure. It is a very uncomfortable thing to attempt. So you got to get comfortable being uncomfortable if you ever want to be successful.
I don't want to live in a hole anymore. It makes me feel poor.
We are poor, but we're happy.
Comme ci, comme ça. Anyway, the views are better above ground. Honey, I'm 7 non-Fox years old now. My father died at 7.5. I don't want to live in a hole anymore. And I'm going to do something about it.
Some people it's attractive and they go, I want to do that too. Like, you seem pretty happy despite all the stress you're under. Like, how are you doing that? And I'll tell people that because I create my own, and my own it's way harder than whatever I'm facing in the world. And that's how I mitigate the stress of success and pressure and criticism and all that stuff. Like, I do to myself way worse than they're ever going to do to me. So that's.
Okay, amazing day, amazing day. Let's get started. Amazing day. I think we're going to start like this. It's something that was said in that podcast, and it was, a lot of people think to yourself that this is just a world that you're living in, that you have to live in, and don't bang on the walls. Just stay confined within this world, because that's just how the world is. Until you realize that everything in this world was created by man, was created by, obviously, by God, but all of the things that were in it that affects you, the things that you love to do, you love to play PlayStation, or you love to read books, or you love to do whatever it is, this been created by somebody just like yourself. So therefore, you're not just an entity living in this world. You can affect this world. Yeah, you can affect it. You can make it to what you want it to be. And that should keep you going, when things are looking bleak and things are looking, mundane. You look around you and everything around you was somebody else who at one point, things were boring or basic, or they was doing the 9 to 5 or was doing something that they didn't like doing over and over and over again. And they chose to change the world, or they had the ability to change the world. Maybe they didn't choose to, but they had the ability to. Yeah, they pursued something that they was interested in, something that they had a passion in, something that they saw as an opportunity, and it effectively changed the world. And out popped an iPhone, or out popped the computer, or out popped, artificial intelligence, out popped the car or the plane, or, whatever else it may be. What does this mean? This means that every day is an opportunity, guys. And, every day we should be trying to see how we can affect this world, because sometimes it does get hard. Sometimes things are difficult. Sometimes you can't see a way out. All right. But just know that many of the people who have done great things also experienced the same thing. Also, we're in a place where maybe things were dark, or things got difficult, and they didn't know what to do, where to turn, etc. And I think it's a great solace to understand that, they were able to find their way out the paper bag, they were able to change their situation and their circumstance. Yeah, a lot of time people think to themselves that changing your circumstances is something that's going to take 20 years. No, you could have one good season. This time next year, your whole life could be completely different. All right, we've all seen the stories of people talking and saying like, this has only happened over the last 6 months, or the last year, or the last 2 years. Yeah, but their life is night and day. All right. So that's what should allow you to keep on keeping on. Yeah. Keep on keeping on. Yeah. You've seen the meme, 6 inches away from gold. Yeah. There's a guy, digging, 2 guys digging, one turns back. He's only this much away from the diamond. Another one keeps going and is able to, dig and get to that destination. All right. Let's go. Let's have a look at these charts and let's understand our more advanced rules that we started going at the end of last week. Let me turn this off just like an absolute disco. All right. We started going into last week in regards to some of the advanced rules. So the advanced rule, if you can't recall, is obviously first and foremost, we want to identify structure. What does that mean? All right. That means, yes, we can look on a larger time frame as you see me do here. Let me just hide one of these indicators. all right? Yes, we can look on a higher time frame to understand what the bigger Russian dollar is doing. Yes, that's a given. You guys should know that like the back of your hand. You guys should not open these markets without going and looking at what's happening on a bigger time frame. Why? Someone's saying, why should we? Why should we bother? Well, you should bother because ultimately you want to know what's going on. You don't want to not know what's going on. You want to at least be able to say, like right now I've zoomed out to say that this market is a bullish market on the larger time frame. Yeah, let alone on the smaller time frames. This is a bullish market on the larger time frame. Okay, and ultimately, you know, you want to be able to understand that. Right? You want to be able to say, okay, this is what it's doing. Now, that doesn't necessarily mean that that's going to allow you to take trades, because you're trying to take trades on a daily time frame. Every single day, you know, or every other day or every week, you guys want to take a trade. All right. So what's happening all the way back in 2005 isn't necessarily going to allow you to get a great entry, but it's going to allow you to see that overview. Okay. And then once we understand where we are in the markets, we start dropping our time frames. So we start dropping down from, you know, from a daily to a 4 hour, having looking at 4 hour structure. And someone's saying, well, how do you tell the 4 hour structure from the 5 minute structure? Well, look, on the 4 hour structure, you're not going to be doing this. You're not going to be doing this in here. You're not going to be doing that. You're looking for the major swings. Let me show you a little trick. You can go cross-eyed. Go cross-eyed at your screen. Yeah. Or turn to your line chart. You want to be seeing those swing highs. Have a look. Swing highs, swing lows. Swing highs, swing lows. Swing highs. That's what you're looking for. You're not going to be like trying to go in and do every little nook and cranny. No, that's a smaller time frame. So in this push here, this swing from here to here, yeah, everything inside within this time frame is minor structure within this 4 hour time frame. This is a major swing high and the major swing low, and everything else in between is below that. When I drop my time frame down, I'm able to look in that push now. Yeah, and in that push, even though it's not the prettiest, be able to see some price action happening within that push. You know, maybe you can do that. Someone else might have just made this last one straight line. Yeah, probably would have, you know, because even going and taking into consideration Wyckoff, let's just say this is a, you know, 5 point push. Now, what do I mean by what I just said? For someone that just went over their head, but there is a school of thought of, Wyckoff theory, which is the market moves in 1, 2, 3, 4, 5 points on a bullish movement, and then makes A, B, C retracement. That's why this tool exists, because of Wyckoff theory. 1, 2, 3, 4, 5, and then A, B, C. Yeah. There's also, I think, a 7 point move as well that the market sometimes can make. All right. This is just my understanding of the market. Just like my general knowledge. I don't trade like Wyckoff exclusively, but I understand it. I have an overview of it. All right. 1, 2, 3, 4, 5, A, B, C. So for argument's sake, have a look. Oops. Yep. 1. Let me make it a different color so we can see it. 2, 3, 4, 5. And then afterwards they say that there's you know, an A, B, C retracement. A, B, who knows where this might go. Now this is just a general idea. This is just a general theory. All right, I don't say a general. This is a theory. Yeah, a style of understanding the impulses of the market. Does it always happen like that? No, because the markets are not black and white. Okay, but it's a general energy. Now, getting back to what is the more advanced additions to our strategy of indication, correction, continuation, understanding discount, understanding premium, yeah, is to make sure that the only time we are going to be entering the markets is after it has done what? Somebody tell me. After the markets have done what?
Motion detected at your front door.
Does anybody know? After the markets have done what are we going to be,
indicated and broken structure.
Indicated and broken structure, that's definitely part of grabbed liquidity. That's what I want. All right, grabbed liquidity. So the indication, correction, continue is how we're in. That is part of our entry rules to be able to see the market indicate, i.e., break structure. You know, more time we want to see it correct. If we, depending on how big we are, time frame wise, we can then zoom in and see an indication, correction, continuation once again for an entry. If we're quite small, we can hit the button in our imbalance, in our fair value gap. Okay. Now, a lot of the examples I was showing you previously, we was looking at, taking that, entering in that fair value gap and understanding or wait until it breaks structure. But the reality is that that indication correction continuation happens on all time frames, even all the way down to your 5 seconds time frame. Yeah, it just depends on how you're looking at it. So say for argument's sake, not for argument's sake.
Motion detected at your
In
front
regards
door.
to, I keep saying for argument's sake a million times, I'm going to stop saying that. All right. So if we looking at any strategy, we understand that below certain levels, we have something called liquidity, especially where we have seen strength and speed, So below any V bottom or any mountaintop, there is liquidity at these levels. Okay. And we understand that for the market to move, just like for your car to move, it needs fuel. Okay. Now the fuel for the markets is liquidity. Do we understand this? Can we commit this to our brain? For the markets to move, we require liquidity. Okay? We require liquidity for the markets to move. So therefore, what we see the market constantly moving in a zigzag motion like this. Why? Because what it's doing is taking liquidity. Above here was liquidity. The market takes the liquidity. Nam. Comes down here, there's a little bit of liquidity. It's constantly searching for liquidity. Especially if there's a big, massive, meal of liquidity over here with hard dough bread and this and rice and peas and everything else left on it. If it's searching for that, you'll see the market moving towards that. Just grab that liquidity, nam, and then decide it wants to make a long journey. All right. So with that said, this is what we are always looking for, identifying where the liquidity is. So if we say this, for argument's sake, is liquidity underneath this level. All right. Because also we want to understand, the direction that the market is going in, because that's important also. Because though the market's going to be grabbing liquidity, it's still going to be falling in a direction or rising into direction. So we want to trade with the trend. Do you understand? We want to trade with that trend. Now I want to have a look here for argument's sake. Above this little high here, there was something called liquidity. Okay. Now we want to see a grab of liquidity. When I say the word grab, I mean I want to see a nice wick. Nam. Eat liquidity in there and come out. See? I want to see a nice wick, eat it and come out. Let me drop my time frame and we're going to have a little look at that little high over there. It's not one I made earlier. I'm just having a look. Okay? Just having a look. All right? So, the market's here pushed above here and grabbed liquidity. Okay. I'll go to my 50 minutes, might be easier to show. And another thing as well is that we want to be taking trades when? When do we want to be taking trades? When are high probability times to take trades? When are high probability times to take trades? Does anybody know? Does anybody know? Because if you don't know, it's a problem. All right. So when are high probability times for you to be trading? Does anyone know?
In the London or New York session.
There you go. Yeah, in the London or New York session, and in particular, the first couple hours of those sessions. All right. In particular, the first couple hours of those sessions. Why? Because that's where all the volume's at. That's where, it's very difficult for the market to tell you lies. It can be volatile, but ultimately it's got things to do. It's actions, work time. Yeah, man are at their desk, man, I've got things to do. Also, orders that weren't filled from the previous session. You listen to me? This is quite simple, a simple concept that people don't grasp. Orders that weren't filled on the previous session, meaning, I don't know, Marcus said to me, Jay, I beg you buy me 1,000, of these. in the Asian session. And for whatever reason, I was too busy in the toilet on my phone doing something else. I don't get all of Marcus's orders filled in one session. What am I going to do? As soon as the next session open, I'm going to be like, damn, let me get Marcus's order filled before I get a slap. That's what I'm going to do. It's that simple. So when the session starts, you see these orders come in, go into places where the market wants to go to. Now have a look at this. This is just not one I made earlier. This is that area where the liquidity was grabbed. This is a wick on the higher time frame. Have a look at the strategy every time. This market wicked up here and grabbed liquidity. It pushed down here and it broke structure. We must see that indication breaking some structure. We must. And when it broke that structure, the market came back in and tapped in to any imbalance. Okay, and in this instance, sorry, it's early, all right. In this instance, there's lots of imbalance. Yeah, there's imbalance, you know, in this little level in here. There's some imbalance over here. If he was taking a trade just based upon just looking at it like this, okay, you could have been like, okay, placed your order here, just stop above here. You'd have been just about triggered into this trade, hopefully. Just about here, yep. And the market would have started running in your direction. Because the market broke structure here and here. This is more significant than here. This is a bit more long and strong, strength and speed from here. And if I drop my time frame down to a 1 minute time frame just to get some more information, some more detail, have a look. Have a look, have a look, have a look at a look. This market pushed down here, breaking some structure. It's not the cleanest. I'm not going to say it's the cleanest here. And I'm actually going to say that there is unmitigated imbalance in here. Unmitigated imbalance in here. Now, definitely, we would have been able to get in here based upon our indication, correction, and continuation. All right, we would have been. No problem. Would have been in the trade, stop above here. Maybe this would have been trade based upon that. Okay, but here, there is unmitigated, meaning that markets have not come back and tapped into this imbalance yet. Now, I don't know when markets come and tap back. I don't know when they want to do so. But if it's unmitigated, then all we do is we identify it and it becomes a POI. For those of you who don't understand what POI is, it's just a fancy word to say it becomes a point of interest. Do you hear anybody talking about POIs and all these kind of abbreviations just to make it sound like fantastic and shot you their course? That's what they're talking about. It's a point of interest. Yeah, this is a point of interest that I would leave on my charts. And I could write in here what it is, you know, if I wanted to. I could say this is a, you know, point of interest. Point of interest, you know, unmitigated imbalance, you know, and I could put a time frame in it. I could put whatever I want to put. And then once I put it in there and it's written in and I'm happy with it, how it looks, showing you something, you can right click it, you can lock it. I can't go nowhere now. I can't move it out of the way. It's there. All right, it is there. All right, now let's have a look. Let's look at another thing. Have a look at over here. I'm gonna drop to my 5 minute time frame. Like I said, that wasn't a great. The liquidity was taken, but it was unmitigated. All right, the area it did tap in. It did tap in on a small level. If we was looking on a 5 minute time frame, the 1 minute it came down here is a little bit more, a bit frilly. But have a look at the time. All right, the time we're looking in and around. This is about 3:30, but it's still within that window. That window, and I told you there's a indicator here that can help you identify those windows. See, that indicator is called ICT kill zones. It's just an indicator, and it just identifies this New York AM session, how we got our London session and our Asian sessions. All right, now look, for example, let's have a look over. Let's look on a smaller time frame. Let's have a look at how this market likes to grab liquidity and how certain things happening. All right. So let's have a look here. This is the London session. I'm trying to find some obvious examples. Now, why am I trying to find obvious examples? Because the markets doesn't give us a trade every day. This is what people don't understand. The markets don't give you trades every single day. So sometimes the markets, they don't give you what you're looking for. Does that mean that we can't trade it? Of course we can trade it, because we understand premium and discount, we understand indication, correction, continuation. But based upon if we're putting in some set of rules, okay, then the markets don't give you what you want every single time. Do you understand? So therefore, you have to be patient and understand what it is that you're looking for. All right. So we are always looking for liquidity to be taken. I'm going to zoom in at some point. I'm going to show you every single time the market takes liquidity on a smaller time frame. But I want to get some telltale examples. All right. So let's go here for argument's sake. So this was only last week. And, you know, you're here looking at this market and you can see an Asian session. This is an Asian high over here and an Asian low. Asian session, all right, trading overnight whilst you're sleeping, and it's kind of just bouncing around. But what we can see here is we can see liquidity sitting above these levels, and definitely liquidity sitting above this previous New York, I don't know if you can see, it says NY PM session. Now there is liquidity above all heights. Even without this indicator on, we would have identified these areas of liquidity. Okay, even without these areas we would have identified these areas above these high wicks and all of these wicks here. The market's kind of sideways in here, not breaking this high, as the areas of liquidity. All right. Now, when this market breaks that level, our alerts are now ringing. Ring-a-ling-a-ling-a-ling-a-ling-a-ling-a-ling, ringing off. This market has taken liquidity. I'm going to drop my time frame down for you. It's grabbed and it's taken some liquidity from this level. All right. Just about as the 7 o'clock, which is London session, have a look, is about to start. But have a look how the market took liquidity and then broke swing structure. 1, liquidity taken. 2, broke structure. BS, let me put BOS because BS sounds funny. BOS, i.e. indication. Writing's horrible. Let me just do this on with a type in it, because I don't know why I'm trying to write it out. All right, so let's go here. Let's go here. 1, break structure. 2, so what am I talking about? 1, liquidity. 2, BOS. 3, or BOS / or indication. All right. Let me drop this down as well. It's pretty big. And then I want to see this market come and tap back in to an area. Ultimately, we can see two different breaks of structure here. Well, here's the main one. All right, here's the main one, but we can see how this market broke this little level in here, but I don't like the fact this is a lower high in here. All right, I want to see this market tap back in, have a look. Because all of this area here has imbalance. There's imbalance all in here. So after this market has taken liquidity, tick box 1, okay, and then we've seen the market break structure, tick in the box 2. I want to see this market come and tap back into liquidity. All right, and let me tell you something. Here is a really nice area. Here is a really nice area based upon what previous things the market's done. Over here, we saw the market couldn't break the structure. Then we saw strength and speed, creating a mirror of this imbalance. Here is a nice area, but all of this area is of interest. And let me tell you something for free. All of this area is only 5 pips. Even above these highs, 5 pips. Let's keep playing it forward. This isn't one I made earlier. I'm just having a look. Yeah? Off to see the wizard. All right? Now, what we're also adding is once we've indicated break of structure, liquidity, sorry, and then break of structure, i.e. indication, all right? And then we want to see the markets tap back into imbalance or correction, all right? Correction. Let me double click this to make this word wrap, it's called, text wrap. Yeah, or correction. Why can't I grab it? Why can't I grab this? There you go. Yeah, or correction. All right. It tapping back into imbalance is, like I said, there's only one God. Call it what you want. Describe it how you want. Is it correcting? Correcting. Now, if you have the ability to identify this imbalance, you can set limit orders, and here is your entry. And anywhere in this imbalance could have been your entry for 5 pips. You'd have been triggered into this trade with room to spare, and now you're profitable. Now, the next thing that we have to identify also, okay, obviously, sorry as well. I'm going to change this. I'm going to change number 1. Number 1 is going to be, if it lets me tap in, number 1 is going to be time frame. Yeah, like or time of day. Yeah, not even time frame, time of day. Because we want to be taking it, as Marcus said, we want to be interested in high probability times. And high probability times is when the liquidity is high, i.e. when London or New York sessions are kicking off or getting busy within those couple hours. People are at their desk, people are hitting the button, phone calls are ringing off, orders are being filled. All right. Now, I don't know, looking at this market, where we're going to go to, but I tell you this, the other element that we are adding to make sure we are profitable is when we get to a 1 to 3, okay, is we are going to make our trade risk-free, and we are going to take 50% of profits off the table. All right, so let's see what happens here. I might get egg on my face. We might get stopped out. And if we get stopped out, I don't feel dumb. Maybe it looks a bit funny on camera because I'm trying to teach you guys something, and this isn't one I made earlier. It's one I'm just picking out. So if I get stopped out, I don't feel, oh, I'm dumb. You guys, and I also think you lot should not believe in my strategy. To be honest, I don't care. Because what I understand is that all trades are not going to be successful trades. And if the one I happen to pick out and we see that we get to a 1 to 2.5 and then it turns around and stops us out, well, it is what it is. That's the reason why we teach risk management. It's not a reason. That doesn't mean that I'm dumb or I don't know what I'm talking about. Okay, let's have a look. Okay, let's pull this down. 1 to 2. But you see here as well, we have to understand that we've broken some structure. And can somebody tell me what's happened here then? What has happened here?
Grab some liquidity.
Grab some liquidity. And if we understand that when the markets grab liquidity, we're expecting to see it run in another direction. So if I was still in this trade, yeah, I might have got a much better entry, to be perfectly honest. I may have got a much better entry than this based upon watching. So let me show you how you get a better entry. Instead of you taking a limit order in here, you can wait to see price action in regards to the candles. And can somebody tell me what this looks like? What does that look like? What is my circle alluding to? What is that circle? What is my circle alluding to? What is it showing? Those two candles. What are those two candles? Remember, these sessions are about teaching, learning, and not just for myself. This is about interaction, and you guys, there's no wrong answers. Yeah? But these candles here are what kind of pattern? We spoke about candlestick patterns, and this is the rock star. one of a duo of candlestick patterns that are the most famous? Anybody know? This is a bearish engulfing candlestick pattern, just like there is a bullish engulfing candlestick pattern. What is a bearish engulfing candlestick pattern? Is when the body of the previous candle is swallowed by the current candle in a current direction, and it has a long wick pointing to either direction depending on engulfing candlestick. I mean, I could do the drawing myself, but I can't bother. All right. You know, we want to see the body of the next like this. Have a look. We want to see the body eating the previous candle. And for me, guys, I actually have quite particular rules about my engulfing candles. I need this green wick to be longer than this wick over here. It's, you know, it's, I don't need to it, but it's more powerful. It's a more powerful engulfing candlestick pattern. All right. We'll go into that. All right. So when I see this is a sell signal. So I could wait until I see this signal here. And really my entry could have been, have a look, this candle like this.
At your front door.
Meaning that at the point when I got down to a 1 to 3, which is over here, this trade would have already been 1.5% profits if I'm trading 1%. Okay. Moving my stop here, just making a line so you can see where my stop is. And it would have been risk free, letting the other 0.5%, the other 0.5% run. All right, so let's see if where this other 0.5% goes. Went to 1 to 4. We've just grabbed some liquidity below Asian session. Let's see what happens. But either way, I've banked 1.5% and it's risk free. I cannot lose, and I'm up 1.5%. All right, let's have a look. Oof. This market is going down here. We're at a 1 to 10. For me, at a 1 to 10, I'm happy with that. Like, I mean, what more do I want? This is a question you got to ask yourself. I'm not trying to say that this market can't keep running on and on and on and on, but I'm asking you a question. If you take a trade and you get a 1 to 10, or I phone Marcus and say, Marcus, you see that £100 you gave me? I've got £1,000 for, you know, I've gone to the casino or I've gone somewhere and I've flipped it. I've got £1,000 for you, 10 times your money. At that point in time, does Marcus say, oh, no, go and get some more? Or does he say, oh, that's really good, bro, run me back my profits? Like, what is he expecting? Is he expecting Jay to come back with a 1 to 100, 1 to 10,000? If you've taken a 1 to 10 trade and you can consistently take a 1 to 10 trades, your entire last name is going to change. Let me say it one more time. If you can consistently take 1 to 10 trades, your last name is going to change. Your kids are going to be all right. Mum's going to be all right. Everyone's going to be all right. So therefore, if you get to a 1 to 10, take that money. Now, that isn't necessarily 1 to 10 in the capacity that you've got the whole 1% running, but you had another 0.5% running. So you took 1.5% at the start, and then at the end, all the way to this 1 to 10, you've taken another 2.5%. Because here, 1 to, so I'm lying, yeah, 6, 5, another 3%, sorry. Because look, when it was at 1 to 3, you took 1.5%. Oh, sorry, I'm wrong. Another 3.5%, sorry. All right, because when it got to 1 to 3, if I can get hold of this thing here, when this got to 1 to 3, you took 1.5%. You modified your position. You took partials, meaning that you had a 10 lot, you made it a 5 lot. You modified it in your MT5 and made it 5 lots, meaning that you took off 50%. And then you move your stop loss to 0 here so that you can't lose. So that if you took 50% off at 1 to 3 and you're risking 1% at a time, that means you had 0.5% times 3 is 1.5% you've banked. Then you've got another 0.5% of your account running, not from a 1 to 3 all the way down to a 1 to 10. So essentially 7 times, yeah? Because you've taken off 1 to 3, and to get to 1 to 10, you've got another 7, right? 7 times 0.5% is going to be 3.5%. Yeah? So your 3.5% on top of your 1.5 you've already taken is 5%. Just made a quick 5%. If you can make a quick 5% regularly, your whole last name changes. Yeah? Let's see what this market continues to do. This is already a successful trade. It's fantastic. Pushing back up. Now we know, have a look at here, even if we look at it on a smaller time frame, so even look at it on a smaller time frame, only thing we haven't done is really identified the direction. We haven't identified the larger direction. Well, the larger direction is bullish. If we was to go on a 1 hour time frame here, we'd be drawing lines looking like this, you know, coming up here, coming down here, coming up here, coming down here, coming up here, coming down here, coming up here, coming down. Well, if we're coming down here, well, ultimately, at some point, we're expecting this, right? This isn't no brain surgery. This is just, I mean, connect the dots. The market's been doing this. Ultimately, we're expecting to do that again. We knew it was going to come back down here. Why? Because it's been coming down here. It's been after breaking structure, coming back down, making a retracement. It's been after breaking structure, making a retracement. After breaking structure, making a retracement, we know it's coming down here. But at the point we get our 1 to 10, we better be happy because realistically, the energy is it going back up here. There's no point us holding on to it for it to come down here. It hasn't told you that it wants to go down there. It hasn't even winked. It hasn't even dropped the shoulder to even say it might want to go down there. Okay? If anything, when we look at it like this market could be coming and closing in balance. So looking at it with the same principle, have a look at the same principle. Look at this over here. Time of day, we'll ignore that for now. This is structure here. And I know if I look back, which I can't be bothered, there is more liquidity levels here, mountaintops around here. So this here is a indication, taking the liquidity on a bigger level, bigger time frame, above here and beyond. Yeah? So this is liquidity. Then this market pushes down here, all right, coming into these levels, breaking some structure in here on smaller time frames, maybe not an hour clearly, but understand this. This is the way, you know, you see me always say it's broken in structure, because every low of these candles are structure. Because these candles are showing you where they opened, where they traveled to, and where they closed. So you understand how the markets was moving within that candle. Let me say that one more time, because somebody hasn't clocked what I've just said. These markets and a bullish candle opens here. Oops. It's not letting me. It's on the snap. There's no snap there. Then it's not letting me go to that smaller point. Let me see if this will let me. No, it's not letting me. All right. Well, opens here, bottom left-hand corner, closes top right-hand corner. And the wicks is where the market has traveled to, the high and the low of that candle. So that's already showing you that this market, this candle moved in a certain way. If I put on these, have you guys ever seen these bars? Look, watch this. Have a look, keep your eye on this little area here. Watch. Showing you where the market opened and where it closed and the wicks of the journey of the candle. These are called, I don't know, bars, supposedly, yeah? If I went to my line chart, you can't see it here because it's too small and the lines doesn't take the sensitivity of the fast wick movements. But that's what's happening. So I know that on a smaller time frame than an hour, structure is being broken by this push down into these levels. So this is an indication, ultimately a correction, ultimately tapping back into structure. Where is there really strong structure here? Well, the market previously, this was a battlefield over here. This was a battlefield over here previously. And there's liquidity below here. Let me make that white. So I'm thinking around this area, whether it's going to be deciding that it wants to just turn around in the battlefield, or it wants to grab some liquidity first, there may be some sort of turnaround here. I don't know. Like I said, this isn't one I made earlier. This is just us looking at the charts and reading it. All right, so let's have a look. Tapped into that battlefield, deeper into that battlefield, maybe at this point in time again for liquidity. And you know what we have to be wary of? What's the time saying? What is this a good time to be getting involved in another trade? into the markets. All right. Well, this is New York. I don't know if that AM or PM session, because this breaks it up into two. We'll see. Watching it. Watching it. Watching it. Eating that liquidity now below this level. Okay. So at this point in time, we've eaten this liquidity. I'm looking at the time. We're going to 6:30. We're going to 7:30. We're kind of out of trading time. Yeah, we're starting to go into out of some weird hours. With somebody sitting there thinking to himself, oh, Jay, blah, blah, blah. I'm saying to you, if we restrict our trading just to those high time frames, we don't have to start guessing some stuff here. Now, Asian session is going to kick in a couple hours. And then it's very possible that instead of this market just doing what it's supposed to do, Asian session, more times out of 10, not all the time, but more times out of 10 likes to consolidate, likes to sleep. So we might see this market doing this for time, Asian session, before deciding to do something else. I don't know. This is, like I said, it's not one I made earlier. I'm just looking at it. I'm just reading the candles. Let's have a look. Get rid of that. Let's get rid of this. Let's have a look. Let's grab some liquidity there. Now we can see here, even just looking here, we know that there's more liquidity below these levels. And then let me not even do 15 minutes. Let's just zoom out. There's more liquidity, below these levels. We know this. However, we're not expecting this market to necessarily come and break this level here, because on the 1 hour time frame, this is our swing low. Remember, this is this market coming up, whether you want to take this one into consideration or here, this is, swing low. All right, swing low with a swing in it. All right. Now, but we have seen this market push all the way here, grab liquidity and tap into, well, coinky dink, some imbalance here. Let me show you something about this imbalance. You ready? This imbalance is part of the leg that broke structure over here. Have a look. If I drop to my 15-minute time frame, we've seen, I'm going to take it back. Okay, because I would prefer to see this wick lower than this wick here. All right, we definitely see an imbalance here, which is lining up with previous imbalance on this side, also previous areas of interest, points of interest here. But let's see. I'm not gonna run with that. Okay, I won't. Okay, because it's more, say, this leg breaking this structure over here. Okay, so let's see where the market's gonna go. Because remember, even though we're saying that and I'm watching it grab liquidity, I'm having to hit the button. I'm not just playing snap as it grabs liquidity. I'm just hitting the button and I'm saying I'm in. So don't think that if I'm looking at things and I see, oh yeah, I think it's this and it's not that, that means somehow I would have lost money in the market. No, I'm not in the trade. I'm just saying that there's liquidity here and it's a point of interest. Just like over here on the 15-minute time frame is a point of interest, so is here. Let's see what happens. But remember the time as well. The time. Here is 7 in the evening based upon London time. All right. Okay. Grab some more liquidity. All right. So nam, we ate this liquidity. Nam, we ate this liquidity. There's more liquidity below these levels. Let's see what happens. Nam, we're eating that liquidity. Nam, we're eating more liquidity. I'm looking at the time. I'm waiting for the time. This is now Asian sessions. So with Asian session, we've grabbed this liquidity. We've broken some structure. So let's play this forward a little piece. And I think the indicator is on. Is that indicator on? Should be on. It's not on. See, can you see Asian session? So Asian session was here. And actually in the Asian session, boom, we grabbed some liquidity below this previous New York session. So in that Asian session, actually grabbed some liquidity, had some fuel that it grabbed and it actually pushed up for a little time in the opposite direction. All right, actually pushed up for some time in the Asian session, grabbed the liquidity from below here, nam. If I was trading Asian session, I'd still be interested in looking at this liquidity level because the market needs liquidity to move. The market actually grabbed liquidity below here and below here. Can you see this low here? Nam. Now we've got a higher time frame break of structure, it pushing down here, because this was our low on our 1 hour. We've got a higher time frame break of structure. Ate the nam, pushed up in this direction, but because the market is now making lower lows and lower highs, and if you want to, you can draw your lines. Yeah, don't hate on the lines. Just some lines. The market is up in a premium. Yeah, of this range anyway. It's in a premium. Yeah, obviously this yellow range is coming near let me say yellow range, they're both yellow. Let's do that and that. This orange range is coming near the bottom of that orange range. Maybe after grabbing this liquidity that we've just grabbed, maybe the market's going to have some sort of retracement back in here. Let's have a look. All right, let's have a look at the look. Market's pushed down. Actually tapped into some more liquidity, which was here. We had, remember, this is London session now. So we're watching London, and in London, the market's pushed down and grabbed liquidity. This is London session. We're interested in what's going here in London session. All right, we are interested. All right, let me show you something else. Have a look over here. Let's drop all the way down to my 1 minute time frame. Focus on this. Let's make it yellow and let's make it dashed. Focus on it, because I want you to understand that when that market's open, there's always this unique energy around the imbalances, the inefficiencies in the market. Okay, are you ready? So say for example here, we've seen the market open, and look at this push down from here, breaking structure. When this market's open, there was strength and speed that pushed in here to break structure. This caused a huge imbalance, and that imbalance in London session has to be filled. And it was filled and pushed down. Now this is a bit, if you're looking here, have a look, let me show you. If you was looking here on a smaller time frame, above this level was liquidity. Let me show you why it was liquidity. I'm not just saying it. Because the markets went up here. I'm on a 1 minute time frame, but it doesn't matter. It's even better on a 1 minute time because I can show you in quick succession within a session. The market couldn't break here. 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 So understand what's going on here. What's going on here is every time it comes up here, there is lots of sellers selling from this price. Yeah? Sellers, yes, it's on a smaller time frame, that's why it's a smaller move, but lots of sellers selling from this price. That's what's happening. The candle isn't just moving down by magic. It's moving down because sellers, selling. Let's get it down. So the market says, okay, you want to go down? Cool, no problem. Let's go down. But before we go down, we want to say out loud.
Grab some liquidity.
Exactly. And when it grabs that liquidity, you don't have to be getting in here. There is a smaller entry here on a very small time frame, but watch. The market pushes down with strength and speed and breaks a structure. All you need to be focused on is that market is going to retrace back to somewhere. Where is it retracing back to? It's retracing back to that imbalance, which happens to be here, like so. Okay, and the wicks over there, might as well place your stop above the wick. It's only 5 pips. When that market comes and taps into here, you may have stayed in this trade. More than likely you would, because GU's got small spread. You would have, you would have stayed in this trade. If your stop was above that high with your spread times 2, you would have stayed in this trade. And then, whilst London session is going on, just taking advantage of the fact that there was an imbalance there, upon London open, it's the time frame that's making me more interested in this trade. Yeah, it's the time frame of making me look at that imbalance that happened. Look at how that ran down there. Great trade. And then down here once again, let's have a look. Let me zoom out a bit. We've seen the liquidity over here. Now I'm going to focus on this wick over here. Let's focus on the wick and see what's going on. I'm going to delete. No, I'm not going to delete anything. Let's just focus on the wick. I'm going to drop down to my 1 minute time frame once again. No, in fact, I'm not. I'm going to go over here. I'm going to draw a line first below this level here. This is Asian session. Yeah, so we can see this little wick over here in a smaller time frame. Let's drop down in here and let's have a look and see what's going on. Let's see what's going on. And remember, I don't know what's going on. This is just, I'm just looking at it right now. All right, have a look at structure. This is all structure coming all the way down here with our levels in here like so. The market broke this little level in here from after grabbing liquidity. What's the time? everything's kind of straying out of our time we want to trade. But we saw this, watch, boom, break up here. When that pushed up in here, on whatever time frame we want to look at it, let's look at it on a 2-minute time frame. We saw this imbalance in here. There was an imbalance between here and when that candle opened up in here. All right, in here. On a smaller time frame, it's there. But either way, we saw this market come and quickly tap in. It's not the cleanest. All right, but we saw a quick price action from there. That liquidity grab. Let me see something. Let's check something real quick. Now, what I would say, look, on a 5-minute time frame, we have to understand which direction is this market going in. Well, this market is going in a bearish direction, making lower lows and lower highs and lower lows. Okay, so when it grabs this, if the market comes all the way back down here, it's not necessarily going to be looking for an entry to push it back above this level, because there's nothing that's told us that this market's going to go above this level. If anything, we're looking for liquidity grab onto to the tops, to the upside. If anything, we're going to be looking for liquidity up here somewhere to be grabbed so we can get involved for a sell in line with the trend. You see it? Yes, we can trade in both directions. We can, if we get what we're looking for. But all the energy is leaning towards selling. So therefore, the things that we're looking for are going to be more frequent as a sell, not necessarily as frequent as a buy. Because the market, the waters are running in this direction. All right. So let's play it forward. Let's say even from here, we can identify from here. We've got London highs. We've got some highs over here on a smaller time frame. Whenever we see mountaintops, remember, is potential liquidity. Whenever we see build up, consolidation, is liquidity above these levels also. All right. Drop down to my 5-minute time frame. Let's just play this forward. See what's happening. Now, this is London, this is New York. New York's just opened here, and New York hasn't, we're just watching it. It's kind of not doing too much, you see? And you see how it keeps us safe. When we don't see the things that we're looking for, it keeps us safe. Look, have a look. On a smaller time frame, on a 1-minute time frame, liquidity was taken by this wick from underneath these levels, and the market ran to the top of New York session. Maybe there's a small entry there on a 1-minute time frame, but yeah, don't really care too much about that. But there, more than likely on a 1-minute time frame, there's this trade. Why would you be stopping yourself out here? Why? Because you've gotten to some structure. You'd be at least protecting your position. If you got so small that you was able to take this trade. But ultimately, the energy is bearish. I want to see liquidity taken from up here to give me an opportunity to get in. Yeah, I want to see structure being broken, indicating correcting and continuing for a sell. All right, but let's see what happens. So now we're in the other New York session. This is the other New York PM session. There was liquidity above this level here. All right, where the New York opened. All right, over there. We've seen a grab of that liquidity. Let's see what happens. Nope, it went all the way up, back up in here because it wants to go for a different session liquidity. It's all New York. It wants to go for the up. The up is not its own, homie over here. All right, this is all in New York. Maybe the up is London session or even Asian session over here. I don't know. Let's see what's going on. Let's see what's going on. All right. Let's get rid of some lines in here. Now, Asian session again is here. So maybe this might be a time where we didn't manage to take a trade. Maybe we didn't get what we're looking for. And that is not a problem. This is the point. It's not a problem. Now, this is Asian session. Again, Asian session gives us an opportunity to frame our moves because we're sleeping. And then we wake up in the morning and we look at Asian session that's been trading within a range. All right. Been trading within a range. Boom. Asian session's been trading within the range. As soon as London session comes, we're getting this liquidity grab, which is what we spoke about a little bit earlier. We're seeing the liquidity grab, and we're waiting to see that indication, that correction, that continuation. All right. So in this instance here, We do have a push down here, and this market does indicate, starts pushing back down into these levels. However, we don't, let me get out of the 5 minute time frame. We don't get that correction straight away. We don't, all right? It pushes down further and we're watching it, all right? We're watching it and we're watching to see how this market, boom, 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 grab that liquidity, push past a level of structure on a 5 minute time frame now. 5 minute time frame level of structure would be, you know, over here. I want to say here, all right, also, okay? But let's go and click forward, see what's happening. We got a lovely tap into this area, all right? So this area is all, remember, all these candles, green, 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 essentially making one big green candle, you know, a point of interest. We did get a tap back in here. Let's see on what time frame. We've got a lovely tap into the imbalance, if any. Let's have a look. Let's have a look at the look. You know, my energy here is about it breaking this structure here, okay, and seeing this imbalance in here, and you would have covered the previous imbalance. Like, even though I'm saying this is here, you wouldn't have placed your entry and your stop there because there's imbalance below. And hindsight's a beautiful thing to go, oh yeah, there's your entry. I see so many people do this on YouTube. Oh, there's your entry. Yeah, how would you have known that at the time? You wouldn't have. You've been looking at this imbalance as well, at minimum. You've been looking at this imbalance as well. Okay, market came and tapped into there twice and then left. All right, let's go look at a slightly different market real quick. See if we can see the same thing. We've been looking at this for some. Let's go to let's go to NAS, the DAX. What is it? I think it's in NAS 100. USD. Yeah. All right. So let's go ahead. NAS. All right. So NAS, the Nasdaq. Let's look for the same stuff. Let's actually do some back testing. Go to our daily time frame. Reset my chart. So good reset. Let me delete everything off here. I don't know what's going on. All right. And I'm going to go back a couple candles. Couple candles on the daily. Oh, I'm going to go back one candle on the weekly. How about that? I'm going to go back one candle. Is that one candle? On the weekly. One candle on the weekly. Now, I think we can see here from the weekly chart that this market is bullish. All right. Cool. We can all do that. We can all get in a trade like that, understanding that, or get in the markets understanding that much. We see the market is trading within a range here. Even if it's narrowed up, maybe there's a narrow range happening here now. Who knows? Who knows? Who cares? All right. General overview. Drop down to our daily. Okay, we can see within that range how the market's been making some higher highs and higher lows. Yeah, like so. Once again, you know, important but not essential for our entries now, us actually making money. All right, but we can see the market tapped into a premium here, So we'll be thinking to ourselves, maybe the market's going to turn around. We don't know. We say maybe it's going to turn around. Let's drop to our 4 hour time frame. This is top-down analysis. We can see the market clearly making higher highs, higher lows, and higher highs, and higher lows, and higher highs, and higher, broken structure. So even if you look at this on the larger time frame, have a look. If we look back here, no, we can't on NAS, sorry, because we are at all-time highs. So we can't on NAS, which is a bad example for what we're teaching, going through at the moment, because we're going through understanding that liquidity grab. But we can pick up on the breaker structure element. We've seen from up in here, have a look. The market was trading. Can you see this? I'm on a 1 hour time frame. There was an Asian session high over here. It was taken over here. We've got London session high. How do I know it's London? It's yellow, the yellow box. London session high. New York session high. Then we've got this stab wound. Taking liquidity. Let's drop our time frame down to a 15 minute. I really want to see those highs. Over here, let me put a vertical line on them. All right, let's go down to our 5 minute. And let's go have a look at that high. Have a look. Boom, up in here, grabbing that liquidity. Yeah, and then we want to see this market like displace. We want to see a push. Yeah, we want to see a push in a direction. All right, let's go and drop down here. And obviously this was the point. You see over here, here was a battlefield. You see above here where this liquidity was a previous battlefield. Why? Because the market came up here, bang, could not break it. Something stopped this market here that couldn't break it. There was sellers here that this market could not break. Let's drop our time frame down, look for some more confirmation. Let me make that a different color. Yeah, something here, which is sellers, sell orders. Let's drop our time frame all the way down to a 1 minute and have a look. I know I'm small on the 1 minute, but I just want to show you guys this. The 1 minute does give us so much information that it allows us to confirm our narratives. All right. Have a look. When the market came back down, we saw it have some love for this area. Came back, tapped into this area here. So this would have been our indication. Look at structure. Now I drop my 1 minute time frame. Look at structure. You see, here's the highest point. This is a low before the highest point. This is a break of that structure. This is the market correcting back into imbalance. And ultimately, if we look left, into a previous battlefield. And then here, we've seen correction. We have seen correction. All right. And more importantly, we have seen correction happening. Look where the close. Have a look at this. I'm on a 1 minute time frame. You know we're waiting for a close of a candle, right? For that continuation, we're waiting for a close of a candle. The market's pushed up in here, indicated, corrected, waiting for a close below this structure. Is it a coinky dink that close happened right on the time that we're interested in trading in this block, which happens to be New York block? Entry. Stop above that high if you wanted to, above the last swing high. Yeah? And then, where's the market going? Once you're in the trade, it is going towards liquidity, man. It took this liquidity over here. Look, as it took it, bang, had a reaction. But I tell you what, the wave that was going bearish was so strong, the reaction just came back into the battleground, continued to push down to grab more liquidity below this level here, previous New York session. Boom. When it broke that level, which was very close to another New York session, have a look. Very close to another New York session, this blue line, the market gave us another little reaction. But the wave was so heavy, this market is bearish and it is like a tidal wave. And if we go on our larger time frames, it was heading towards higher time frame liquidity zone. Remember, we might be able to see all these little levels on a 50-minute time frame, but on an hour, they just disappear into a one spike. This market pushed through all of this liquidity. Nam 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 nam. And then the market over here started to go sideways, slowed down. Look at the range. Look where the liquidity is. Below these levels, look, London, New York. And then we see John Wick coming and doing damage. John Wick is all about liquidity. Nam, nam, nam. Let's have a real look right in that John Wick over there. See what's going on. All the way to a 1 minute time frame. I'm looking in that circle that I drew. Hopefully it's right there somewhere. There you go. Very fast. Too fast to get any type of handle on. Because the markets, that was definitely some news. Made it spike down there. Definitely. All right. But what I will say to yourself is this. When this market spiked down there, structure was here. All right. As well as here. As well as here, as well as here, okay? And this break, this impulse that led to the break is where the market came back to that structure, that push of where structure was broken, which is exactly the same as a previous battlefield. Came back to that previous battlefield, and that's where it decided to return the boat and start making its way. Didn't come back and violate this area. It left. In fact, it came and tapped back in, but it left. Okay, so what's my point, and what are we learning here? Well, we're learning the market's like liquidity. We're learning that if we take a trade, we have to understand that the markets are going to come back and tap into areas, previous battlegrounds, especially if we can identify imbalances, gaps, points of interest there. We're also learning that ideally, have a look over here, ideally, this market, look at it here, for example, pushed up in here, London's, New York just started, there was liquidity above here. As soon as that market nams that liquidity, nam, the market comes back in, taps back in, it's on a very small time frame. Let me show you something. I'm gonna show you if it gives me the data. Hopefully it gives me the data. I'm gonna drop down to my seconds, and I'm looking in this circle here. Drop down to my 5-second time frame. Hopefully it gives me the information. Hopefully, I'm looking for my little circle that I drew. So I want to show you the exact same strategy, the exact same thing that's happening, even on a second's time frame. Here it is. I don't know how I've got two screens going on down here. It's mental. I don't know how that's happened. I actually don't know what I've done here. I've somehow pulled the indicator down here. If I've been able to do that, that's actually quite good. Anyway, we'll see. Yeah, we'll see. If I've been able to do that, that's actually great, and I'm gonna start doing that. So it's just down here. All right, have a look. Some liquidity was taken over here. I'm talking about in a short term. This here is our New York session, our window. Have a look. Like I said, this isn't one I made earlier. This is just me reading the candles, seeing certain things. Nam liquidity was taken. A push down, breaking some structure below these candles, breaking some structure. Where is it going? It's coming back to tap into the imbalance. Yeah, imbalance up here. Taps in, boom, gives us an entry. Your entry would have been like this, for argument's sake. Oops. Would have been like this. Yeah. Or even if you just wanted to cover that last high, or better still, maybe here would have been your whole entry. From down here, understand this is all imbalance up here. Place your spread above it. So this is only 15 pips on NAS, it's nothing. And be able to get this market had a reaction. All right, from here. I'm just showing you that wherever liquidity is at, this market's going to react. Wherever liquidity is at. Now, if you combine that with trading in the right direction, and within our time frames, yeah. And sometimes if you're sitting around and saying, look, I want to buy within my time frame because the market's bullish, you're going to wait for that buy signal. You're not going to do anything else. You're going to wait for that buy signal and that buy signal only. Okay. Let's have a quick look at this and we'll finish up right now. So we'll finish up. So let's try and get to, I'm going to delete this because even though I like it's being down here. In fact, cool. We can leave it in here for now. Let's play it forwards. I'll go to my 50-minute time frame. I'm going to play it forward. I'm going to try and play it forward. I'm going to move it to 10. It's moving too slow. I'm waiting for. No, I'm looking for this. Let me get rid of this indicator. I want this indicator on my actual charts here. I just deleted it, it looks like, unfortunately, which means all my settings, no, my settings should be okay because I've saved it. So let's see, ICT, kill zones, pivots, in here. Yeah, my settings are saved. All right, so look, so now we're watching this. All right, for example here, look, London session. Let's rewind to here. Another time we can see a trade. Okay, oops. Do you want to exit? No, I don't. I want this. Another time you could potentially see a trade. Maybe. All right. So we've seen here, the market's in here, London session. We've seen this market push down below here, grabbed liquidity below this level. because below all Mount V bottoms and V tops, there is liquidity. All right, let's play it forwards. Nam, nam, nam. All right, liquidity has definitely been taken. Just like on the opposite side, you know, liquidity was taken. When liquidity was taken from this, the same principle. We break structure, then we tap back in. Oops. Then we tap back in. This is the opposite side. We broke structure and then we tap back in. All right. Can't see it here because it's happened so small. It's happened in a smaller time frame. But understand, when we grab this liquidity, the market likes to tap back in. All right. When we grab this liquidity from down here, the market likes to tap back in. All right. And then when we combine that, which what I haven't done here, is which direction the market's going in and where we are, whether we're in a premium or a discount, it allows us to take some high probability trades. So just looking at it, zooming out, we're looking at this, that this market is quite low down in the demand area, though we're getting some pushes below here, which is a bit concerning, but that might just be the push below to grab liquidity to make some, you know, nice higher highs. Let's see what happens. Lovely. Lovely jubbly. Over here, there was liquidity. The market took liquidity. Yeah, if I put my little vertical line in here now, when that market took liquidity, let's drop all the way down to a 1 minute time frame. Let's have a look. When the market broke structure, where's the structure that we can see? You can see structure here, you can see structure here, you can see structure here. We've got our indication, we've got our correction, we've got our continuation. We're in the game. But over here, the only issue is we're out of that time window that we want to be trading in. See it? We're kind of out of that time window a little piece. So here, what I can see here is, watch. I can see that the market's in here in this little level. We got the market pushing down, all right, from here. And that caused imbalance. Within our window, we saw that market come and tap back into imbalance, push down and break structure, gave us a lovely entry in here that we could have taken a trade from that imbalance in here. Could have taken it just on the imbalance, placing our stop above this level, and the market pushed out in this direction out of our New York session and continue to push. And understanding our new, way that we make sure that we take our profits is when this market gets to a 1 to 3, which was over here, we take 50% off. How do we take 50% off? We modify our position. Whatever number we've got in, we half the number. If we've got 5 lots in, we modify it to 2.5, meaning that it takes off 50%. Then we make it risk-free. Now we're laughing because we just made a 1.5%, and now the trade is risk-free, and we're now trying to bank some other stuff. Yeah, this market's here making some New York lows. I'm a bit concerned because we're right here in a discount. Is the market going to tap in and do something? Let's watch it. Let's play it. New York, it's in here. We're watching it and we're watching it. Boom. Boom, boom, boom. Because below here, we're seeing liquidity. If I go to a 5 minute time frame, look at that. Spikeage. Yeah? Spikeage into liquidity, spikeage into our, trend line over here. Okay. And at that point in time, do we see a reaction? We do. That push goes and pushes and breaks structure. I'm expecting it to tap back in to potential areas of imbalance. I don't know. Let's see what happens. All right. Managing my risk. Taps in. Oh, lovely. Lovely entry, tapped in, pushed over here. Is this market now going to trade towards some more liquidity above these levels and previous liquidity levels? All right. previous liquidity levels. Is it? I don't know, because I don't have a crystal ball, but I understand how to trade liquidity, indication, correction, continuation. Let's have a look, see what happens. See what happens. Lovely jubbly. Pushed up there. Took some liquidity from above this level. Yes, it's within the same session, but liquidity still lives here. But we're going to trade away from where the market is. Within this whole New York session, we're trading away from where the liquidity is being grabbed. All right, so on a 5-minute time frame, you can see liquidity being grabbed there. Boom, we're going to trade away from that, especially as we're in a discount. All right, we're going to trade away from it. So let's stay in there. We've taken our 1.5%, plus we're staying in there. See if we're going to take more liquidity to the upside. Let's see. It's testing us. Pushing up and more. But I'm concerned right now because now we're in Asian session. So I'd be out of this trade by now. I wouldn't be holding it through Asian session. Why? Because Asian session normally dances around. So before Asian session kicks in, I would have closed my trade here. Cool, I'm happy, mate. Profitable. Lovely. Yeah, Asian session comes in now. Now we're dancing. Cool. I want to wait till the next morning, see what Asian session frames the liquidity above and below. Look at London kicked in. Look. As soon as London kicked in, boom, we start seeing this thing start to move. Starts moving in gear. Breaks some structure down here. All right. Once again, this is a liquidity grab. Nam, 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 nam. Now, is this market going to tap back in here and push down further? Or is this market going to push back past here because we're in a discount? I don't know. But I'd be watching it right now to see whether or not when it gets back into this battleground over here, what happens. I wouldn't be fast to just jump in this. All right, let's see what happens. Okay, push down, made continue to come back in this level, push down, made a manipulation W, but not quite because it hasn't broken this structure. 1 second, guys. Yeah. So I'll be watching this through London session. All right. I'm looking at here. This market's still tapping it because we're in. You know why? Because we're right in a discounted area, which is this line here. And I know that regardless of this, that, and the third, ideally I want to buy from a discounted area. That's how I'm thinking. Until I see the market breaking structure and show me something different, that we're no longer bullish, I'm going to buy from here. So when I see this market break structure over here, see this push here? Now I'm thinking to myself, this is more an opportunity here to get involved in a potential buy. Because that's what I want to do. I want to buy this market. Yeah, that's what I'd be thinking to myself. Taps in. Woo! Start to move. You see it? You see how we're combining the overall direction with the overall understanding of the markets grabbing liquidity, with understanding that the market, when it moves away with strength and speed and creates this displacement, that the price likes to tap back in. And in here, on a smaller time frame, trust me, is an indication, correction, continuation. But we can either look at it on a very small time frame, try and get an entry, or we can simply place a limit order when that market comes back into that correctional space, if we're in very small. All right, look, I can also see a bullish engulfing candlestick pattern. Look, this here, which is giving me, and this is another bullish engulfing candlestick pattern. So we've got one bullish engulfing, another bullish engulfing. We're getting all these signals saying, you know what, that's what we want to do. So I'll go back to this bullish engulfing. I also see an imbalance. That's my target, man. That is my target. My target of this market is going to tap back in is right there, right by a bullish engulfing. Yep. If I was very aggressive, I'll take it like this. If I'm less aggressive, I'll put my stop below that bullish engulfing wick. Nothing. For NAS, that is nothing. Let's see if this NAS is going to push up and go and take Asian highs. Let's see. Well, it did take Asian highs over here. However, we saw this spike come all the way down here, so, and then take it. Now, we would have still been in, all right, but it's possible. Let me see. We got to 1 to 3. No, we didn't get 1 to 3. So we would have still been in this trade. We would have gotten up here to our 1 to 3. Yep, we would have. And we would have made it risk-free. and taken 1.5%, and then this market would have come and wicked us out for 1.5%. Yeah, so another very profitable trade. This wick is definitely news. It's a very strange wick, all right, but ate all the liquidity below these little levels. Guys, have an amazing day. Today I want you to go and combine the things that I've shown you, being very strict about the sessions, and do some back testing. Remember, if you don't see it in one session, cool. Traders are not supposed to be trading every day. You're supposed to trade when you see it. That unmitigated area of imbalance, the market wants to come back there on a higher time frame. When it comes back in there, do you see it? Indicate, correct. Do you see it move away sharply? Is it within your time frames that you want to trade in? This is going to make you more profitable because you're only going to be trading within time frames. If you lose, you lose. And if you win, you're going to win at least 1 to 3, take off profits, and then you're going to let the rest ride. That could go. And if you get to a 1 to 10, you're going to take that money because that is a 5% trade. 7 5s, yeah, it's about 5% trade. Yeah. I hope this has been a good session that you're going to be able to test some stuff for yourself. We are keeping, nothing's changed. We're just combining the fact of understanding liquidity and the best times to trade. Can you take trades outside of this time that make you money? Yes, you can. Is that going to be a trade that maybe it's going to take longer? It's going to fast about, might not decide to do what it needs to do. Yes, because the volume is just not there. The impetus is not there for it to do something. There's nobody in the market. You know what I'm saying? Like the rave's not going to be popping when there's only 4 people on the dance floor. It's not. People are going to start acting strange, start talking, having a mother's meeting, deciding they want to just sit down and be on their phones. That's not common to the rave. You went to the rave for it to be popping. When it's got high volume, there's lots of people there. It's going to be raving. It's going to be doing what raves are supposed to be doing, raving. You get what I'm saying? It's the same with the markets. Hence the reason why these kill zones exist. So that's when it's popping. Yeah? Guys, have an amazing day. We're going to watch a session by Ben Shafi, paying off £130,000 debts from prop firm trading. See what he's got to say. For those of you who are watching on YouTube, like, subscribe, get involved in the good stuff. Remember, this is just about being able to see it, being able to stay disciplined with it. And when you see it, it's obvious. Like when you see it, like, oh, damn, this just grabbed liquidity and then the push out just broke structure and now it's coming back into that area. It's going to be so obvious. It's not going to be like, I'm not too sure. It's going to be like, that is obviously a trade that I can take. If it's starting looking a bit like, I'm kind of reaching, did it really? Leave it. Leave it alone. Have the discipline and the fortitude to just leave it alone and be like, you know what? I didn't really like the look of it. I left it. I kept my money in my pocket. Keeping your money in your pocket is a lot better than you blowing your accounts and losing your money. I'm telling you. Right now, however much money that you have in your bank account, you'd prefer that money stayed exactly what it is compared to it disappearing tomorrow. Yeah, obviously you'd prefer to grow it. Yeah, I'm sure. But definitely your second option would be at least don't make it go backwards. So don't take the trade. Yeah, there isn't trades that are clean like that every single day. Not unless you're very small on your 1 minute time frames and you're very nimble. And then, you're a bit more, it's a bit more advanced, a bit more frantic, and you should still be only trading within, you're still looking for what you're looking for and only trading within your kill zones. But guys, amazing, amazing, amazing day. I hopefully